Good morning, everyone. This is Rob McDougall with Zhang Financial. Today is Monday, February 6, 2023, here with your weekly economic update. So, the economic data released last week, chock full of very impactful data points. So, we'll start off with on Tuesday, we had the January Consumer Confidence. Now, this is a conference board, it's not the University of Michigan. So, this is for January, not for February. It came in pretty much in line, a little below expectations, came in at 107.1, consensus was 108. So really nothing to speak of there in terms of market impact. Wednesday, we had the ISM Purchasing Managers Index. This is manufacturing. This was the fifth consecutive drop for this index, and it is the third consecutive month being below 50. You'll remember I repeat this all the time. The demarcation between expansion and contraction is 50. We've had 3 months in a row below 50, and it's sunk all 3 months. So you would think that's a bad data point, but not necessarily. In that, we're all looking for, as investors, the soft landing. We've got the Federal Reserve increasing interest rates, which will definitely slow the economy. So the hope by the Federal Reserve and all investors is that we have a soft landing. We slow the economy enough that inflation goes down enough that the Federal Reserve doesn't have to hike any further. So the fact that we have manufacturing activity that's below 50 for a few months, that's not necessarily a bad thing. In fact, the markets kind of welcome that as a bit of a relief valve in terms of inflation. So also on Wednesday, the much bigger point, the big point of the last week, Federal Reserve Open Market Committee rate decision that came out on Wednesday. As expected, there was a 99% probability of it happening, Fed futures market, suggesting it came in at 25 basis points. So the new range is now 4.5 to 4.75. Looking forward, next meeting, March 23rd, there's a 99.6% probability of exactly a 25 basis point increase, a further 25 increase, a 0.4 expectation, 0.4%, that it might be 50 basis points. So at this point, everything that we see pretty much locked in, one more 25 basis point increase. Now, if we look out to the May Federal Open Market Committee meeting, there's a 99% probability built in that between now and then, 3 meetings, we'll have a total of 50 basis point hike from the current 4.5, 4.75 up to 5 to 5.25. But then by the end of the year, the expectation is there's a 46% probability that we'll be back exactly where we're at right now, 450 to 475. And there's an 82% chance that will be 475 to 450. So expectations are definitely leaning in the camp that the Federal Reserve is near the end of their tightening, and there's better than average odds they're going to actually have to cut by the end of the year. So last few data points from last week. Friday, the non-farm payroll. Now this is one where when you see the number, you would think this is really bad for inflation, means the economy is overheated. Now remember, last quarter, real GDP growth was 2.9%. It was 3.2% the quarter before. Those are very strong numbers. So this non-farm payroll, new jobs added for the month of January was really strong, far better than expectation. Expectation was adding 190,000 jobs. We came in at 517. But the rest of the story, if you look under the covers and take a look when you split it up between full-time and part-time workers, this tells an entirely different story, something I should have been tracking before, but just picked up on last week. So if we go back to last May, the U.S. economy's added over 1.5 million jobs since then, quite a bit more than that, I think, but well over 1.5 million. If you go back to May, the number of full-time jobs added in the United States through January, negative 233,000. The number of part-time workers added during that time, 1,634,000. So here's the takeaway. We're seeing really strong job numbers, but you're seeing it's not rattling the markets, particularly in terms of inflation. That's the reason why. These jobs are everything we're adding are part-time jobs, which can easily be shed by corporations. They're at the low end of the wage scale. And so on the same day that we got that news of this hyper strong growth in jobs market, we also got the average hourly earnings for workers. That decelerated from 0.4% the month before, month over month, to positive 0.3%, the best we've had in 5 months. So in terms of inflation and the impact of wage inflation, that is a very good and encouraging metric. So inflation expectations last week, based on everything I just gave you, particularly that jobs number, you might think the expectations would be going up, actually went down again last week. So the 10-year break even now suggests that inflation over the next 10 years is going to average 2.22%. 1 week ago, that was at 2.33%. So also on Friday, we had the ISM Service Index. I'll point this out. I might have overlooked this one or bypassed it, except for the fact that last month, this metric fell off the charts. It was very stunning. I was very surprised to see it. So you had the month of November, a 57 reading for this. This is the ISM Services Index. It's been positive, consistently positive going back. It rarely goes under 50. But it did in the month of December. It came in at 49 roughly. So that really got my attention, many other people, obviously. That rebounded very strongly. Came in at 55.2. The consensus was 50.3. So whatever happened in December, not sure what it is, appears to be an aberration in terms of services. Last thing for last week that I'll talk about in terms of economic and data points hitting the market, S&P earnings. So what we need for the market to continue its very strong start this year is we need to see the Fed continuing to give us good news on the potential rate hike scenario. That'll only come with inflation coming down on a strong, consistent basis, which we've seen. But we also need corporate earnings to hold up. So corporate earnings here for the fourth quarter, which is now being reported, half of the S&P 500 companies have reported. 70% of them have beat their earnings consensus. However, the 10-year average is 73%. So while it kind of looks like a good quarter, it's not. Expectations have now dropped for the fourth quarter. Coming into the quarter, the expectation was S&P 500 earnings to drop 3%. Now it's the expectation it will drop 5.3% when everything is reported. For the rest of this year, I should say for 2023, expectations have continued to come down. The expectation now is for the full year, we will average a little bit over 3% EPS growth for the S&P 500, but a negative 5% in the first quarter, which means it's all back unloaded for 2023. So the expectation for the fourth quarter 2023, which we have no idea what it's really going to be, the expectation is over 8% increase. So back and loaded EPS for this year, and we're closely watching the S&P earnings, but I do have to admit, so far the fourth quarter earnings, a little disappointing. So the market, how did the market react to all that news that I just gave you last week? We had another strong week in the equity markets, kind of a flat week in the fixed income. So last week, S&P 500 up 1.6%. Growth did lead the way again, but so did U.S. small value. So when we take a look on a year-to-date basis, that big advantage that value had over growth last year is starting to unwind a bit. Growth in the U.S. up 14.7% year-to-date. Value up nicely, but 5.2%. But on the other side of the ledger, large versus small, small cap has been beating large consistently. Small cap U.S. stocks now up 13.7% for the year, large cap 7.7%. So kind of offsetting metrics for our portfolios, which do skew towards small cap and towards value stocks. So the 2-year the 2-year yield on the treasuries was up 21 basis points. 10-year was up 14. You'd expect a poor bond market. Actually, it's pretty flat. So the Bloomberg U.S. Aggregate Index was positive 0.3 basis points, U.S. government down 5 basis points. So really not much to speak of there. The one thing I will point out is high yield. Obviously, investors are gravitating towards riskier assets here, which doesn't always end well, but high yield last week was up 1%. So, last part of the presentation here, the economic news coming out next week. Thankfully, a very slow economic calendar. There's only one that I think is significant coming up. That'll be on Friday. That's the January U.S. Consumer Sentiment Index. That's the University of Michigan Index. That was up strongly last month for the month of January. So December 59.7, January 64.9. Expectations, it's pretty much going to be flat month over month. Consensus is at 65.0. So very little coming up this week, but we'll leave it there for this week. And thank you very much for attending. We'll look forward to seeing you next week. Thank you.